blowout. That's how I would describe this quarter for one of the top businesses in the world. Historically, the months of February, March, and April are the keys to success for this business, and they certainly delivered, and then some, in this period. I'm referring to tax season, a time dreaded by all Americans, but for Intuit, it is their Super Bowl. It is hard to find the words for just how good this quarter was, but in today's video, we're going to do just that. Welcome to The Quality Investor. Pre-market, we're seeing gains of nearly 8%. The market loves what Intuit did this quarter, and with good reason. The appetizer is a beat on the top and bottom line. Revenue of $7.75 billion versus estimates of $7.56 billion, and adjusted earnings per share of $11.65 versus estimates of $10.91. The dessert, however, is even sweeter. Intuit, ticker INTU, raised guidance across the board. Intuit now expects revenue, operating income, and earnings all to come in higher than expected at the start of their fiscal year. This is driven by much better growth in two segments. First, their consumer group segment, which houses TurboTax, saw huge gains in revenue, 47% year-over-year growth in their TurboTax Live offering, a direct competitor to H&R Block, and now makes up 40% of their consumer group revenue. They also saw massive strength in their Credit Karma segment with 31% year-over-year growth. Credit Karma's growth for Intuit has been a bit slower than expected since they acquired them back in 2020. But with 32% growth in Credit Karma year to date, the segment is starting to show itself as accretive to Intuit's bottom line. The operating margin has jumped to 34.4%, up from 22.9% a year ago. Intuit's total operating margin is 30.6%. So Credit Karma is indeed accretive. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. But another reason for Intuit's success this quarter lies in their economic moat. One sign of a strong economic moat is pricing power. Pricing power is a vital aspect of a quality business. When a business has pricing power, the ability to raise prices 1% to 2% above the rate of inflation without affecting volume, then customers might gripe a bit, but ultimately demand is unaffected. This signals a competitive advantage and drives marginal profitability. Warren Buffett once said, "The single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising a price by 10%, then you've got a terrible business." It means the business is providing something of such value to a customer that they'll pay more for it, regardless of economic circumstances. This is a defining feature of Intuit. In their Global Business Solutions segment, which houses QuickBooks, Intuit cited higher effective prices, customer growth, and a shift in mix to our higher priced offerings as the reason for year-to-date revenue growth. Higher prices and customer growth, pricing power. In the consumer segment, growth was driven again by higher priced and additional service offerings, underscoring pricing power once more. At the same time, TurboTax grew its live offering volume by 24%. However, on a down note, its total share of IRS returns was down 1%. Intuit said this was mainly due to its pay nothing cohort, or free tax filers, being down from 10 million customers a year ago to 8 million customers today. As for paying customers, though, average revenue per return increased by 13%. Credit Karma also sees continued strength in credit cards, personal loans, and auto insurance. This calls into question the media narrative around looming recession. One hallmark of a recession is access to capital tends to dry up. Intuit is executing on all cylinders. So let's quickly review these earnings, look at their outstanding raise in guidance, and most importantly, assess whether or not this company still has enough margin of safety to buy more shares. Pre-market Intuit is up just over 7% as of this recording, so we should expect to see a very nice pop today in the market. This underscores a torrid 3 months that Intuit has had in the market, gaining, well, excluding today's price pop, 18% over the last 3 months. The market is certainly pleased with not only this strong quarter, showing Intuit's continuous dominance in the tax prep market, but also the raised guidance. Customers are buying what Intuit is selling and the market loves it. This was an outstanding quarter for Intuit. The growth in every segment has been outstanding. 19% year-over-year growth for Global Business Solutions, 11% for the consumer segment, which houses the TurboTax, 31% for Credit Karma, massive growth, and 9% for their much smaller ProTax segment. This translated, of course, to 15% year-over-year growth for revenue. But what's really important here is the growth in the Credit Karma segment. I mentioned they made that acquisition back in 2020, but as you can see historically, growth has been difficult to achieve. They lost 9% in fiscal year 2023 and only grew 5% in fiscal year 2024. But we're finally seeing the type of growth we expected out of Credit Karma when they made the acquisition back in 2020. They're now forecasting 28% year-over-year growth for this segment. For the other segments, we are expecting now 16% growth for Global Business Solutions and 10% growth for the consumer segment. ProTax still at a small 3 to 4% growth, but we don't really expect a lot of growth out of that segment going forward. In total, that's 15% year-over-year growth for Intuit, and as we can see, that's growth acceleration, 13% here in fiscal year 2023 and 13% again in fiscal year of 2024. And in the quarter that makes its money for Intuit, tax season, we saw an earnings per share on a GAAP basis of $10.02, and they're now forecasting $13.19 to $13.24 for the entire fiscal year, a huge increase over last year's earnings per share number of $10.43. Intuit is a growth machine, a compounding machine, and this really translates to free cash flow. Operating income on a year-to-date basis now is at $5.8 billion, up from the $4.5 billion at a year-to-date basis 1 year ago. Even better, this is a very capital-light business. Intuit does not have to reinvest heavily back into CapEx to spur growth on a going forward basis. And you can see that here in the purchases of property equipment. Only a $99 million year-to-date capital expenditure outlay compared to $208 million 1 year ago. That translates to $5.7 billion in free cash flow on a year-to-date basis, which is an outstanding 34.5% increase year over year. Like I said, Intuit is a cash-generating machine and will be a very strong business going forward for years ahead, especially if they expand internationally, which is part of their big growth trajectory. Please check out the deep dive I did on Intuit explaining their future growth strategies. So what are we assuming the growth will look like the next 10 years for Intuit? Of course, it's important we understand this if we want to know what a good buy price is for this business. And we can see the last 5 years, the total revenue has grown an outstanding 19% annually. But for the next 10 years, I'm projecting growth in the Global Business Solutions segment on a bear case of 11.4%, 13.5% on the base, and 15.7% on the bear. We can see on the Credit Karma down here, I'm now projecting 6.76% growth on the bear case, 8.71% on the base case, and 10.66% on the bull case. My prior growth projections were in the 5 to 7% range, so this is a big boost in the Credit Karma segment. And for the consumer group, I didn't really boost it all that much. Still projecting 6.8% for the bear case over the next 10 years, 7.8% on the base case, and 8.8% on the bull case. This gives us total revenue growth on the base case going forward of 11.4% and on a bull case of 13.3%. So still less than what they have been growing over the last 5 years. Another outstanding aspect of Intuit's business is they have very strong operating leverage. Because what they offer is software packages, additional units sold result in higher marginal profitability for every dollar of revenue, meaning they increase their operating margin. By year 10, I'm expecting on a bear case the operating margin to grow to 27%, 30% on the base case, and 33% on a bull case. And we can see that translate very well in free cash flow growth, where in a bear case I have free cash flow margin coming in at 35.4%, 40.7% on the base case and 46.3% on the bull case. And that's with a $1.76 in free cash flow conversion. But for year one, I'm only estimating a $1.67 in free cash flow conversion, yet that translates into 32.3% year-over-year growth. This is a cash generating machine. And I'm actually not expecting that free cash flow conversion to change all that much by year 10, up to the bull case of $1.74. Of course, the PEG ratio is high for Intuit. The average is 3.38, and I'm basing that on the forward PE of 50.5 over their 10-year projected earnings per share growth. This is a very high PE business, certainly trades at a premium, so if you use the PEG ratio as an indicator, it might be a bit overvalued at the moment. Intuit closed out the day yesterday at $666.07. This, of course, is their pre-earnings trading price. We'll see what they do today in the market, but that is a PE ratio of 54.1 and a forward PE of 50.4. We expect both of these PEs to go up significantly with today's pop and share price. But despite the high PE ratios, their current PE sits just above their 10-year average, and their forward PE is right in the middle of their 5 and 10-year average. As I just showed you, the PEG ratio indicates a business that is overvalued. But here in the Quality Investor, we like to look at what the discounted cash flow is doing. And on the bear case, I have a discounted cash flow price of $694.95, $912.73 on the base, and $1,192.09 on the bull case. Intuit pays an excellent growing dividend. Their dividend for fiscal year 2025 will come in at $4.16, a 16% increase over last year. And I expect dividend growth to continue at a high rate, between 13 to 15% going forward. This is due to the very low free cash flow payout of this business, which hovers just under 20% at the moment. So in a bear case dividend discount price, I have it at $632.35, $782.19 on the base case, and $1,007.70 on the bull case. And for the exit multiple, I have them at $850.70, and I'm using comps of SAP, Salesforce, ServiceNow, Cadence Design Systems, Autodesk, and Roper Techs. So at the moment, there's quite a bit of upside for Intuit based on these numbers. Even the bear case is showing 7.8% upside, all the way up to almost 60% upside for the bull case. So without any margin of safety, that's a buy price of $877.01. With a 20% margin of safety, that gives us a buy price of $701.61. Right now, the price in pre-market trading is at $715. So depending on where your margin of safety at, if it's in a 10 to 15% range, Intuit may be a good buy. If you want a bit more margin of safety there to account for any risk going forward, waiting until the price comes down below 700 might be a good idea. We know with pre-market surges in price that things don't necessarily last throughout the day. So a $715 share price pre-market is very possible it could come back down below 700 by the end of the day. Either way, there's very strong prospects for this business going forward. They still dominate both in the small business segment with QuickBooks and in self-tax prep with TurboTax. And we're now seeing real growth out of Credit Karma, which is marginally expanding their bottom line. So going forward, Intuit, I think, is a very strong business. It's well positioned to capitalize on growth in the future. And as Intuit expands internationally, there seems to be very good potential going forward for Intuit. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.